What is going on, y'all? We have a lot to cover today, particularly celebrity coins, some going up over 1,000% in just days. We're going to cover the CPI print this week, the FOMC meeting this week, and a lot more, so stay tuned. All right, y'all, let's just jump into this. So if you didn't know, Iggy Azalea, I think that's how you pronounce her last name, has jumped into the crypto arena. She is quote unquote in the trenches, as crypto natives would say. And she launched a meme coin, I guess it was about a week ago, a little bit over a week ago. And I find this very interesting. And I think this is probably going to be a whole new narrative, a whole new meta to keep an eye on. I think that these things potentially could be sort of like the NFT craze that we had in 2021. If we look at this coin, it's called Mother. That's her meme coin. After launch, so this was, after launch, we were roughly here. And as of right now, you're up like 2,500% from here. Okay. And we saw other celebrity coins at launch around the same time doing 10x in just a few days. I'm not saying that I agree with these or that they have value, but what I'm trying to say from a trading perspective, it's hard to say that these are not good opportunities if you know what you're doing, if you time it right, and have the risk management skills to deal with these type of high risk plays. But I want to put it on people's radar because it's a remarkable opportunity, again, with little amounts of capital. I don't typically play these that much. I don't really trade a lot of meme coins, but I do think that I will probably start to trade these as more celebrities come out. If you can get a good entry like this, under 10 mil, fully diluted value, that's a pretty good entry for something that, let's say in the case of Iggy, who has 7 million followers on X. I'm sure she has probably more than that on Instagram. It doesn't take a lot of capital to push these things up a lot. Is it musical chairs? Absolutely. But this is what's hype right now. This is what people want to engage in. And I know there's, we have a very wide audience paying attention to these videos. So I do want to put this on people's radar. If you're into this, it is gambling, not financial advice, very high risk, but it's a pretty fun game to play if you're a trader. Okay. Let's focus a little bit more on, well, actually, you know what? Let me finish one thing about this. The reason why I'm bringing this up first is because I think that potentially every single celebrity will have a coin, pretty much. And not just celebrities, but brands. Anything that is an attention grabbing mechanism, right? Like celebrities of the current day, and I guess maybe always, their superpower is to suck people's attention. And usually this translates into financial gain or something, right? How much attention can we suck? Well, these are basically attention coins, right? And the celebrities and brands that can create them, like basically a black hole for attention, will do the best. And on top of that, maybe most importantly, the marginal cost to create a meme coin is basically zero. It takes about 5 minutes to create a meme coin. So why wouldn't brands or individuals do this? What is like, there's really not a lot to lose and potentially a lot to gain if you're clever and actually how to create some sort of use case for the coin. Now, to be fair, people haven't really figured that out yet, but I think people will try. Again, it's marginal cost. The marginal cost to create these things is zero. So I think for a lot of brands and people, this will be pretty obvious going forward. Now, people thought this would be for NFTs, but we're seeing that meme coins are really easier to deal with and I think more simple. So I want to put this on your guys' radar because I think you're going to have an entire run of just celebrities creating meme coins. And for this channel, we want to cover the trends before they really get started. Well, let's talk about the week ahead. So last week was pretty slow for the most part. We had, JOLTS, ISM, PMI, and a few other things. But for the most part, you didn't really have anything until Friday, which was NFP. And this really shifted the market. We had a higher than expected NFP. I want to talk more about this. I think there's some nuance here. But we also had a tick up in unemployment. The market did not like this. It nuked before the session closed, the U.S. session, including crypto. And I say nuke, but it had a retracement, especially crypto and especially altcoins. And I think the reason why is we really wanted to see that number come in lower for the market to get excited and front run any, an FOMC or CPI print. But because it came in hotter than expected, it doesn't make a lot of sense for people to really not be hedged going into another event that could go maybe unfavorable. Now, I want to mention that this non-farm payroll has been notorious about not being very accurate, meaning they go and revise these things and they find that, oh, actually, there wasn't that many jobs added in whatever month they're revising. So I think that smarter, cooler heads are going to view this as not necessarily a very strong signal, but it's something. And given that we have multiple risk vectors, the CPI print, the FOMC in particular on Wednesday, why not hedge going into the event or hedge going into the weekend? And that's what we saw. Unemployment did tick higher, and this is really, I think, maybe more important than non-farm payroll. Obviously, they're both important, but the reason why we keep bringing up non-farm payroll and unemployment-related statistics, data prints, are because the Fed has a dual mandate, as they call it, where it's price stability, meaning inflation or not inflation, and employment. Now, they really have three mandates. We can talk about this maybe more, but financial stability is another mandate of theirs. They may not say that, but it definitely is. It's probably their number one mandate, in my opinion. But jobs are going to be important going forward, because if we do start to see more unemployment, lower NFPs, the market's going to like that, because that likely means that rate cuts are coming sooner than later. Now, I think rate cuts are coming sooner than later, even if we get unemployment staying where it is and non-farm payroll being as expected or a little hot. And we can go into that. I'll just tell you right now, the main reason is this, okay? The Fed already thinks that it's being very restrictive. So this is Joseph Wang. He actually worked for the Fed. He knows a lot about how they think and really where their head's at, okay? And they actually think that they are being restrictive, because they actually are, versus a lot of other central banks. And if you notice, if you've been paying attention, other central banks, okay, including the ECB, started cutting last week or the week before that, over the last few weeks. It's natural to assume that the Fed is going to be next. And there's so many reasons why they need to cut rates. But I think the most important, or my biggest point is, they are, whether they want to admit it or not, either consciously or subconsciously, a political organization. I mean, they are a bureaucracy. They work in the established, excuse me, I just hit my mic, the established bureaucracy of the United States. That is their group. That is their, collective organization, if you will. I'm not trying to, go too far out here, but they subconsciously want to protect their group, their tribe, which is the bureaucracy, okay? And if they break things going into the election, it just about guarantees Donald Trump gets elected. Why would they want to be, responsible, or at least within the public eye of their peers, be responsible for getting Donald Trump elected? So this is why I think they want to cut sooner than later, because every day that goes by that they don't, the risk that something could go wrong going into the election increases. And I think they know this. They've already been tight in terms of their policy. And what's keeping inflation up most likely is shelter, which is about 33% of the index, okay? Of the core inflation, okay? And that needs to be said, okay? Because that's not likely to go down very easily. So at some point you have what's called diminishing returns. So if I'm hitting a nail and I have the nail all the way down, why would I keep hitting the board if I can't move the nail any further? It's just diminishing returns. And that is where they are with inflation. They've hit it down about as far as they can. Now they're risking breaking things to get it down, more than they have. And they're not likely to be able to do that, is what I'm trying to say. So this is just kind of common sense, maybe even just street smarts, that they do not have the incentive to be hawkish. They do not have the incentive to break things. And what they want is to have people convinced that they really care about inflation without actually really trying to drive it down. Because if they really did that, they would probably break something, or at least in their minds, the risk is greater than the reward. I don't want to spend too much time on this, but I think it's really important to mention that, because a lot of traders are thinking like like the Fed's trying to do the right thing, whatever that is, or that they're trying to do the logical thing. Well, no, they're trying to do what's in their own self-interest, just like any organization, any group throughout history is going to do what's in its own best interest. It is not in its own best interest to get someone elected that is anti-bureaucracy, right? Okay, so let's just move on to some of the things next week. We have core CPI on Wednesday, and I think that this will be, I have no idea what it's going to be, but I think it will set the tone for the FOMC that we have later on that day. It's kind of interesting. These are coming in on the same day. And then the next day after that, we have PPI. Here's how I view FOMC right now. The Fed wants to be dovish. They do not want to, they're obviously not going to raise rates, and they don't want to cause financial instability going into the election. So I think they will try to be as dovish as they can without telling the markets to rip. Okay, they don't want the markets to necessarily rip because it does hinder their ability to bring down inflation. But the reality is, at this point, they're going to choose the lesser of two evils, and in their minds, they do not want to be the cause of a Donald Trump presidency. I think this is so obvious, and I know a lot of people will disagree and say they're not a political organization, but that's just not right. That's just not how human beings operate when they're in groups. They're going to protect their group. I've said this like 10 times in this video, and I keep saying it. The Fed is doing what's in their own best interest. Okay, I'm not going to harp on it anymore. Maybe I will. I said I wouldn't already. But if you don't bring this forth, people will miss the bigger picture. Is that the Fed is really just a psyop at this point. They're not that important for the prices of Bitcoin, crypto, and other things. They are in the short term, but the reality is what is moving the markets is the flow of funds, global liquidity. The Fed is not going to try to hamper liquidity coming into the financial system. Okay. And also the Treasury. The Treasury and the Fed will, I think, kind of work together in some ways in terms of maintaining financial stability going into the election. Okay. So let's talk a little bit about charts here. I know I just went through a rant. Thank you for listening to my TED Talk. If we look at Bitcoin here, and let me zoom out, we can see that Bitcoin is currently close to the highs here. And look, it's still chopping around. I have this box here because I think if we get some data that the market doesn't like, there's a decent chance that we could find our way somewhere between 67 and 65, 64 and a half roughly. And this would be perfectly normal, guys. The market really doesn't like these rejections off the high because a lot of people get long. They're worried about how we chopped around for 6 months last or the majority of the summer last year. They don't want to do that again. But at the end of the day, if you look at this objectively, global liquidity is trending higher. And then from the technical standpoint, you're above the 50-day moving average. You're above the 21-day moving average. You're even right at the 8-day moving average. So there is nothing bearish about this chart. We have a lot of wiggle room all the way down to this 100-day moving average for the price to chop around if it has to. And that is okay, guys. Bitcoin's not in a rush here. I do think there is a decent probability that if we get a dovish Fed, we get a as expected or lower CPI, that we could start to see this breakout, okay? But at the end of the day, if it keeps ranging, well, that's just the way it is. And there's no point, I think, in fighting the market or trying to overtrade the market, getting chopped up. It is summer, and summers tend to be pretty low volatility and low volume, and that's okay. If we look at ETH, in a similar boat, it has pulled back from this roughly 3,800 level, and now it's trying to find support. As you can see, it's below its 21-day moving average, so not quite as strong as Bitcoin, but still above its 50-day moving average. Has quite a bit of wiggle room as well. If we look here, you can see that. Bear with me here. We can see that. From 3,300 roughly to about 3,600 is an area that it could see some accumulation if we get a pullback. From the CPI or FOMC. Okay. Very bullish on ETH. I think it goes a lot higher. If you're in the Discord, you know my thoughts. I talk about this often. I'm very, very bullish on Bitcoin, ETH, and Solana right now. So let's cover Solana. Solana's in a sort of a similar boat as both of them in the sense that it's still in this constructive consolidation. And I'm going to remove some of this stuff here. As you can see, it's above its 100-day moving average, currently right on the 50-day moving average, but it is below the 21-day moving average. This is just consolidation before a leg higher, much like Bitcoin and ETH. And I like to look at this pretty simple. So this trend line is going back all the way to, this rough trend line, or actually pretty solid trend line, is going back all the way to last year. As long as we stay above this trend line and this 100-day moving average confluence, I'm bullish on Solana. I think Solana, Bitcoin, and ETH will do very well. I'm not so convinced that alts will do well. If you look at a lot of alts right now, they don't look that great. So let me just show you Avalanche, for example. I mean, this thing is basically at the lows almost of when we had that nuke back in April. It hasn't really done a lot, but really had distribution selling as it consolidated here. And we can see that even some of the winners of the last month or so, like Near, is not looking so great really either. I'm not saying this looks terrible, but altcoins in general are not looking that great, guys. So I'm not saying that some memes won't do well. Obviously, we talked about how Mother has done really well, but this is very isolated. In terms of the overall altcoin market, especially the boomer coins or the coins from the last few cycles, they're not doing very great. So I think that from my perspective, it's better to focus on Bitcoin, ETH, and Solana until we get a more broad scale move in the market, meaning more liquidity is starting to come in that can kind of lift all boats. Not there yet, but I think we will be there in a few months, if not a few weeks. All right, guys. Well, that's all we're going to cover today. As I always say, come join us in the Discord. We're talking more in depth about these topics, and we would love to have you there. And until next time, happy hunting, friends.